Well, thank you, Tim. Thank you, David. It's really a pleasure to present here on ShareCafe today and to familiarize the audience with the Armour Energy story. Fundamentally, Armour is one of Australia's leading domestic explorers, but also underpinned with a firm production base. Thematically, we are primed for growth and focused on delivery. That's one of the things that I'm almost, pathological about saying what we're going to do and doing what we say. And that comes right down to quality of execution. We have a vast prospective acreage in proven fairways. We've got a deep multi-TCF resource project and prospects pipeline. We have material reserves already established with growth from overlooked pay from previous operators. And we've got this long life production with near-term growth in that production in our core production base in the Surat Basin in Eastern Australia. We are an operator of most of our assets, which gives us a lot of flexibility in terms of how we deliver, when we deliver, how we manage our focus in terms of an ability to focus on our highest and best opportunities. We also have significant infrastructure and capacity in that infrastructure as we increase production. We also, uniquely for the size of a company, have a unique positioning of our resource base, both reserves and contingent and prospective resources, in close proximity to the essential infrastructure to deliver our natural gas reserves and resources to market. We have established clear priorities and are absolutely focused on delivering to those. And we've got an experienced management team that are committed to this execution. Next slide, please. To familiarize people with our geographies, we've got 4 core areas with our core production area in the Surat Basin with direct access to the markets of Gladstone and Brisbane in the large-scale LNG projects that are exporting massive amount of Australian natural gas to the markets across Asia. We are a supplier under long-term contract to one of those LNG projects operated by APLNG. We have a vast acreage position, and we're really the frontier explorer to establish the prospective resources of the Northwest Queensland and Northeast Northern Territory, our Northern Basins area. And we are one of the few players, I think the only player in those Northern Basins that have actually established a conventional oil and gas resources, not just unconventional, with existing discoveries, which we're actively progressing to development and production, with a stretch target of putting those discoveries into production by 2022. We have newly acquired acreage in the Cooper Basin, which I'm highly familiar with from my days at Drill Search, where we were focused only on the Cooper and had grown Drill Search from a sub $40 million market cap company to over 800 million, which was subsequently acquired by one of its operating partners, Beach Energy, who many of you are familiar with. But also uniquely positioned, we've got a significant position down in the southern basins of the Otway and the Gippsland. Next slide, please. In terms of our corporate snapshot, we have a market cap of about 16 million. We have just under 5 million of cash on hand. We have proved and probable natural gas reserves of 150 petajoules of sales gas, significant amount of liquids reserves, oil, condensate, and LPGs, and we have significant 2C contingent resources that we want to move into reserves over the next year. Moving on to the next slide, my leadership team. We are very, very focused on delivery and how we can maximize the value of our existing portfolio. Next slide. In terms of our operational and financial performance, it has been a strong past year for us, in spite of the challenges of the COVID-19 pandemic. We have the strong focus on building up our existing production. We have recently demonstrated how we can get more out of existing assets with the successful stimulation campaign at our Mile Creek 5A well. And we're now looking at implementing an additional 6-well program to deliver the same sort of results out of other existing wells, to try to move our current production rate of about 8 terajoules a day to up to the 20 terajoules a day based on our existing Kincora gas plant capacity. We have been focused and have demonstrated our ability to drive down operating costs, drive down G&A and corporate costs. We have also demonstrated our ability to reduce debt through selling non-core assets, where we have recently brought in over $10 million, 50% of which has gone to debt retirement. We've actually brought our debt down by nearly $10 million over the last year. And we have some very exciting assets in the Cooper Basin. Next slide, please. I've already mentioned our substantial reserves and resources. Here's a very detailed table for people to go through. I challenge many of the companies to point to this level of reserve, contingent resource, and prospective resources that Armour has under its belt. Next slide, please. I mentioned our proximity to markets and our proximity to essential infrastructure. You can see the flames across the map in terms of where our core assets sit in their proximity to accessing all the Australian markets from Darwin to Melbourne and all points in between. That's a very unique position for a company of Armour size. I'd probably say the only comparable players that have that same asset spread are both Santos and Beach, which are ASX 100 companies. Next slide, please. We've got a clear growth strategy. We've successfully completed the first 2 stages of that. We're part of the way through the delivery and stage phase 3, and we've got a clear pathway in phase 4, where we've already started delivery there. Next slide. In terms of those priorities, we've got a very clear priority to increase our current production rates by another 4 to 6 terajoules a day from our 2021 Surat development work program, and deliver those on time and on budget. The objective of that is to generate sufficient free cash flow to cover all operating and corporate costs, and ultimately provide future reinvestment capital for further development and exploration expenditure. We've got a priority to bring in a joint venture partner on our vast 100% operated acreage position in the Mount Isa Superbasin in the Northern Territory. Objective there is to recover our historical investment costs, apply that recovery to a substantial reduction of debt, and to secure significant amount of free carry for our future work programs in that acreage. We also have assets that on our balance sheet are underutilized, and we want to put those assets to work with a view to recover and release value, which we can also then apply to further debt reduction. And clearly, one of our key objectives is to materially reduce our current debt position, ultimately to deliver a strengthened, unencumbered balance sheet, allowing maximum business flexibility. We also want to consolidate in our core areas, and that'll continue to be a significant focus for us. We've got clear work programs set out for the coming year, and as I said earlier, we want to be recognized as a company that says what it's going to do and does what it says, and then come back and remind you that we did have a very clear plan, that we delivered to that plan, and delivered the value of that plan to our existing shareholders. Next slide, please. Cora Area Surat Basin. That's 100% owner and operator of the Kincora gas project. It's quite significant. It's closely located to one of Australia's major gas supply hubs at Wallumbilla, which means it's very strategically located. We've got significant 2P sales gas reserves, and we have a large position of uncontracted gas that we look to maximize the value out coming forward. And we have transformational exploration opportunities within that acreage. Next slide. Just a quick overview of that Kincora gas processing plant and infrastructure, where we have significant existing capacity and significant ability to expand the capacity of that plant. Next slide, please. In terms of our near-term development program, we've demonstrated what our chairman likes to refer to as vertical exploration. We've recognized that previous operators overlooked a lot of significant resources in existing fields and existing wells, and we're going back and harvesting those, demonstrating the producibility of those zones. We have an upcoming 6-well program that we're going to execute in 2 stages. The green stars reflect the first 3 wells that we're going to go and re-enter those existing zones, stimulate those zones, and look to replicate the same result we got out of the Mile Creek 5A well, and with a view of significantly ramping up existing production to take advantage of that existing gas gathering and processing capacity that we have. We should have that program commenced by the end of September and fully completed pre-Christmas, with a view that we'll commence the second stage of that program in the March-June quarter next year, with seeking to replicate similar results as we look to reach for that 15 terajoule a day and ultimately up to the 20 terajoule a day. It is a significant program that we can replicate as we have more than over additional 10 wells to pursue these same sort of projects in successive campaigns. Next slide, please. We have significant exploration potential within the Surat, where there's a multi-TCF tight wet gas fairway that's already been demonstrated. I was involved at another company where we actually did the discovery well that proved that up, that play up, which is now being pursued in the immediate adjacent acreage to us by Shell and Santos. It's quite exciting for us, and we're looking to really ramp up our activity in the next 18 to 24 months to pursue that activity. Next slide. We also have one of these underutilized assets, which is quite unique to Armour, which is the Newstead gas storage project. It's an existing gas storage. It's proven. At this point, it's underutilized. That storage alone is equal to an existing Q-Flex LNG tanker. When you look at what's happened in Australian gas prices over the last 12 months, where they've come down from over $8 a gigajoule to under $3 a gigajoule, and we have underutilized storage, it's a perfect opportunity for us to partner with someone to store a lot of gas quite quickly to capture the arbitrage opportunity as gas prices rebound, as they're expected to, as we get through the back end of the COVID crisis. It has significant expansion capacity as well, where we can take that single LNG tanker worth of gas storage to up to 4 to 6 LNG tanker volume. So it is goes from a $25 million worth of gas price arbitrage to well over 100 million, and on very little capex. Next slide, please. Our next big core area are northern basins. We hold a dominant position in both the McArthur and the ISA Superbasin. Multi-TCF. In the McArthur, we're 100% operator. We've got significant both conventional and unconventional gas play fairways, multiple conventional existing discoveries. We've got world-class prospective resources, both conventional and unconventional, that are also almost eye-watering in scale. In the ISA Superbasin, we recently brought in Santos as our joint venture partner there, where we now hold a 30% interest covering over 40,000 square kilometers, with 6.6 TCF of net gas reserves to Armour, not reserves, but prospective resources. Let's dive in closer on our McArthur Basin conventional. This is a play that Armour holds uniquely. We are the only person that holds this acreage. We are the operator. We have existing discoveries. We prove the play. This was not recognized. This was not established by anyone other than Armour. And we are actively progressing this from discovery to production, and going through a process with the Northern Territory government to convert these into production and retention licenses, and with multiple replicable locations. It is low cost, it is proximate to infrastructure, it is proximate to market. And we're looking to turn this into a very exciting opportunity for our shareholders. Next slide, please. We want to lead our unconventional plays in the area with that conventional, so that we can follow up and show the prolific nature of the McArthur Basin, but lead it with the conventional and follow it up with the unconventional, which is multiples of what we already have in the conventional play fairway. Next slide, please. I already mentioned our joint venture farm-in with Santos, where they're carrying us for the next 4 years on a $65 million worth of work program. And we look to assist Santos in every way to maximize the value of that acreage. Next slide, please. We recently have entered the Cooper Basin with key acquisitions and key acreage in the northern flank oil and wet gas fairway, and in the southwestern flank oil and wet gas fairway. Armour is the operator, 100% acreage holder, and as soon as we complete these acquisitions, we will be the fourth largest 100% acreage holder in the South Australian Cooper Basin, which time and time again has shown how prolific it is. Next slide, please. We are applying a state-of-the-art technology to really demonstrate how, what I'd say, underexplored and underexploited the Cooper Basin is. You can see from applying this advanced seismic, 3D seismic analytical technology, that we're able to very quickly and rapidly see what others haven't seen, applying the latest in essentially 3D seismic artificial intelligence interrogation. So we see it as an extremely exciting opportunity for us from an exploration perspective. Next slide, please. We have our position in the Southern Basin, where we have existing contingent resources in the Gippsland Basin, in the Wombat, Triffin, and Gangle accumulations. We also have a significant conventional footprint in the Otway Basin that we're looking to advance now that the drilling and production moratoriums that were put in place in Victoria have been listed, which allows us to get back to work as of July next year. Next slide, please. To round it out, we're primed for growth and focused on delivery. We have vast prospective acreage positions, a deep multi-TCF resource project and prospect pipeline. We've already have material reserves with growth from overlooked pay, long life production assets with near-term growth and activity. We are an operator with significant infrastructure and capacity and room for growth within that on a very low cost basis, virtually zero cost in the Kincora plant, up to 20 terajoules. Well-established pathway to these premium markets. We've got clear priorities and focused on growth and delivery, and we've got an experienced team that knows how to do it. Thank you. I'm ready for questions.
Thanks, Brad. We've got time for one. There's been a lot of M&A in the areas that you're playing in. Do you see that as an opportunity for Armour?
It is. I think there's always an opportunity for consolidation. One of our priorities on our priority slide was to consolidate within our focus areas. We want to continue to build the company, both organically, but also through consolidation. If it adds value to our existing assets and we have the capacity to add value to those other opportunities, we see those as natural bolt-ons to us.
And Brad, I'll give you one more because it's a bit of a theme. They're talking about, a lot of investors here asking questions about debt in terms of when you're going to pay down debt and what's the strategy for that?
Look, I think in our clear priorities, we've identified at least 3 ways that we can significantly reduce our debt quickly in the near term. One, we've got organically delivering on our organic projects to increase operational free cash flow. 2, we have a focus on bringing in a joint venture partner in recovering invested capital out of our material position in the McArthur Basin. Now, we've got a demonstrated track record of that. When we brought Santos in, that has already brought in $21 million of upfront payments. And of that $21 million, we've already used $10 million or nearly $10 million to reduce debt. We have more of a significant investment in the McArthur Basin. And if we simply replicate what we've done in the Superbasin with Santos and are able to capture, which we definitely believe we are able to recover that same amount of capital, we can nearly have our existing debt. We also have, third, we've got underutilized assets like the Newstead gas storage project. We see that as a significant opportunity to unleash additional capital, a unique position with a unique asset, with a unique value proposition that is the right type of asset at the right time. If you look what's happened in, let's say, the global oil markets, you have big commodity financial players that have actually gone out and are leasing oil tankers simply to buy oil cheaply and store that oil and then take it to market. That's exactly the same sort of opportunity that Newstead represents for somebody else who wants to do that around gas that's right there, cheap at the Wallumbilla hub. Newstead sits right on the doorstep of Wallumbilla, and you've got 3 of the biggest LNG export facilities that are ultimately going to be wanting that gas at higher prices. So there's a massive arbitrage opportunity. That gives us an opportunity to unleash even further capital. And with that, I think we can exit by executing those 3 strategies in the near term with a relatively unencumbered balance sheet.